if silver goes into the same type of bubble that it was in 1980 against the other asset classes in society, including the growth of the money supply, currency supply, the growth of the real estate, the stock market, bonds, I compare it against everything that I can think of. And it all points toward triple digits and in some cases quadruple digit silver, which I don't think is going to happen. But I do think a 10 bagger from here, $300 silver, that is entirely possible. But it takes monetary demand. It takes the public rushing in and switching from gold to their preference to silver. I think that'll happen. 3,000, we're already up to 3,500. It'll happen once the public comes charging in. They haven't. Nobody owns gold yet, and many, many fewer own silver.
Silver experienced a modest decline on Wednesday, trading at $32.82 per troy ounce, which represents a 0.26% drop from Tuesday's price of $32.91, according to FXStreet data. Despite this slight pullback, the metal has demonstrated impressive strength in 2025, posting a 13.60% gain year-to-date. Industry expert Mike Maloney envisions remarkable potential for silver, suggesting that a price of $300 per ounce, nearly 10 times current levels, is entirely possible. This dramatic rise, however, would require significant increases in monetary demand and a fundamental shift in investor preference from gold to silver. Maloney believes this transition will eventually occur, though he acknowledges that current ownership of precious metals remains limited, with few people holding gold and even fewer investing in silver. For silver to reach $100 per ounce, it would need to more than double its previous record high. Such an achievement could materialize if industrial demand continues to outpace supply, particularly in expanding sectors like green energy and electronics. Additionally, increased safe haven buying during economic downturns or geopolitical conflicts could provide the necessary catalyst for such a surge. Maloney points to historical precedents to support his bullish outlook. During the 1980s, the gold-silver ratio stood at approximately 50-1 before dramatically falling to 14-1, triggering significant outperformance by silver. In recent years, the gold-to-silver ratio has reached extreme levels, sometimes exceeding 100-1. This distortion typically occurs when demand for gold as a safe haven asset increases, while silver, with its greater exposure to industrial demand, experiences more volatility tied to global economic cycles. Historically, the gold-silver ratio maintained greater stability, generally ranging between 15-1 and 30-1, often supported by legal requirements under bimetallic monetary systems. If history repeats itself and this ratio returns to more traditional levels, as Maloney suggests, silver could once again dramatically outperform gold, potentially validating its ambitious price targets. Before we dive in, don't forget to subscribe, turn on the bell for notifications, and share this with anyone who might benefit from it.
I think that people that have financial planners and advisors should start advising their advisors. Learn as much as you can about it. One of the things that I said in my previous video was that the best investment that you can make is in your own financial education. That's the most important thing. And so if you feel that you're starting to know more about it than your financial planner, financial advisor, either start educating them or fire them. Yes, but that's my own opinion. But this chart, to me, shows that gold has a long way to run because nobody owns it yet. There's very few people that have any significant portion of their assets in gold. And when you look at where it was back in 1980 at the peak, it just sort of reiterates that the financial advisors will all start telling you to go for gold at the wrong time. This chart would have been like the 0 to 1%, meaning 0%, because nobody recommends 0.7%. Those columns would have been up close to 100% back in the year 2000 when gold was just $250 an ounce. Nobody, in fact, all of your advisors would have been telling you to stay away from it, that it's dangerous. The financial planners, they're usually doing something where they're selling you a product that they make a commission on. And so just because of that, and it's slow for them to figure out products where they can make a commission. There will come a day where they'll all be able to make a commission on some gold product or another. And as we go into a blow-off top and it becomes easy for them to sell this idea to their clients, and their clients are, yeah, put me in gold. Well, that's exactly the wrong time. If you want a confirmation on that, watch the comedy Brewster's Millions. And John Candy brings in this financial advisor and John says, oh yeah, he's got me in collectibles and stamps and even in gold. And this is like, it was released in 1982 or 83 after the bull market was over with. This is when the bear market had started. And it is typical for financial planners and mass media. There really was no reason to go with it. I let the gold-silver ratio determine what I buy. And at 100 to 1 right now, it might go higher. And there are people saying that it's going to be this way permanently. The second that gold goes to a price where people go, wow, this was only $250 an ounce back in the year 2000. Maybe I should be buying silver instead. That's what caused silver to explode in the 1980s, is when gold got past a certain price and it seemed relatively expensive and silver was cheap. But the gold-silver ratio back then wasn't 100. It was like 50, and it went to 14. And so there was a tremendous outperformance by silver. And I've made the case, if you don't have my latest book, you should at least, it's only $9.99 for the Kindle version. And in there's a chapter on silver that explains if silver goes into the same type of bubble that it was in 1980 against the other asset classes in society, including the growth of the money supply, currency supply, the growth of the real estate, the stock market, bonds, I compare it against everything that I can think of. And it all points toward triple digits and in some cases quadruple digit silver, which I don't think is going to happen. But I do think a 10 bagger from here, $300 silver, that is entirely possible. But it takes monetary demand. It takes the public rushing in and switching from gold, their preference, to silver. I think that'll happen. 3,000, we're already up to 3,500. It'll happen once the public comes charging in. They haven't. Nobody owns gold yet, and many, many fewer.
Mike Maloney highlights a critical historical distinction in gold's market position. In earlier economic eras, gold served as the foundation of the U.S. monetary system and actively circulated as currency. Today's landscape stands in stark contrast. Gold functions as a freely traded commodity, with its value determined by open market forces rather than government-mandated fixed rates, which were characteristic of systems like Bretton Woods. The contemporary era of gold pricing effectively began in 1971 when President Nixon ended the Bretton Woods Agreement, severing the direct link between gold and the U.S. dollar. This watershed moment allowed gold prices to float freely for the first time in decades, unleashing significant market volatility throughout the 1970s. As stagflation gripped the economy, investors increasingly turned to gold as a haven, driving prices upward. This momentum culminated in January 1980, when gold reached what remains its inflation-adjusted peak, approximately $3,300 in today's dollars. Following this historic high, the precious metal entered a prolonged decline that persisted through the 1980s and 1990s, eventually bottoming at just $253 per ounce in 1999, amid a period of robust global economic growth and reduced demand for monetary alternatives. Let's get back to the video.
First of all, it wasn't a confiscation, it was a gold nationalization. They didn't take it from you, they bought it from you. But they bought it from you for $20.67, and then the following year unpegged the dollar from gold and then repegged it. And over a 2-month period of doing that, the international exchange rates changed to where gold was $35 an ounce. At that point, it had made up for the fractional reserve scheme that the Federal Reserve was perpetrating on us. And it accounted for all the currency that had been created. And so they froze it at $35. There was no longer, there was a 100% coverage for the currency that was out there. Also, gold was the monetary base, and it was in circulation as U.S. currency. This time, it is being freely traded. The price is not determined by, it's no longer $35 an ounce as determined by the Bretton Woods system. It's freely traded. And then there's all these huge institutions that if it was nationalized once again, it means like GLD is one of the big, JP Morgan is one of the big custodians for GLD now. And so it means the U.S. government confiscating or nationalizing J.P. Morgan's, the GLD holdings and so on. I just don't think that they can do it this time. However, if a currency is dying, a country will probably do almost anything to protect that currency. So if we do go into some type of hyperinflation, at some point, you may want to try and front run something like this, but it's not going to happen. unless there's this huge hyperinflation going on and gold is soaring to an infinite price against the dollar, and they've got to protect the dollar by nationalizing gold and controlling it once again, because gold is that canary in the coal mines. And if they do that, it's going to be at an astronomical price. And then you sell it and you get rid of your dollars and you buy something real right away. Real estate, high dividend yield stocks, just something else. Cameron, the guy that used to put up the news on goldsilver.com, he would go, wow, I had to really go deep for that one, talking about deep into the internet, really digging to find stuff. And Tim Burris would find us the most obscure data sets and so on to be able to analyze and make these charts from. And it did contain a lot of new stuff. Another guy gave it a 1-star rating because there was no Kindle version. Well, the following week, the Kindle version came out. Another guy gave it a 1-star rating because he lived in New Zealand and the freight was high. Is that my fault? Those 1 stars are what keeps this book from being a 5-star. You see other people and their plan is working out, the people that are just buying gold. You have to question yourself, but usually I've found throughout my life, that's as soon as I go with the crowd and sort of alleviate my own fears by going with the crowd, that's when it comes back to bite me. And I should have just followed my plan. When I developed plans while I was writing my first book back in 2005, 6, and 7. And for the most part, I really stuck with them. When I diverged from those plans, like for instance, I did a study on the Barron's Gold Mining Index versus gold. So you've got the top tier gold miners in the world in that index. And from 1971, I believe, Alan, we found that gold, the physical metal that can't go bankrupt and have labor disputes and stock dilution and all of that kind of stuff, had outperformed the Barron's Gold Mining Index by a factor of 8.
Gold and silver have experienced significant shifts in their roles and pricing throughout history. Once tightly linked to the monetary system, with gold circulating as currency and silver used extensively in coins, both metals were removed from their fixed positions during the 20th century. The end of the Bretton Woods system in 1971 marked the beginning of a new era, in which both metals were freely traded and subject to market forces. While gold reached historic highs in the 1980s before enduring prolonged periods of decline, silver has followed a similar, albeit more volatile, path. What are your thoughts on the future of gold and silver in today's market? Drop your comments below. We'd love to hear from you. If you found this video helpful, make sure to like, subscribe, and hit the bell icon for more updates. Thanks for watching.